This kind of loan is never due and payable during your lifetime. In this episode, I am going to explain reason number 2 out of 5 to borrow money instead of withdraw money from an IUL policy. By the end of this video, you will understand what a phantom loan is and why it is never due and payable during your lifetime. So I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for more than 48 years. And so I'm very passionate about helping you understand how to optimize your assets, minimize taxes, and when you hit retirement, your golden years, how to not outlive your money like many Americans do because they follow the herd. They have their money in tax-deferred IRAs and 401ks in the market. I have a lot of episodes on this channel that talk about how to do a strategic conversion and have your income be 40, 50, 60%, even 100% tax-free. I actually have clients that have $8 million accumulated from starting out with just $500,000. It doubled every 7.5 years, and now it's worth $8 million, and it generates $800,000 a year of tax-free income. You can do the same thing, and this is far better, and they are actually borrowing on their money rather than withdrawing it. And people go, what? Why would you borrow? Aren't they going to charge you interest? Well, let's take one step at a time as we go forward. At the end of this episode, you're going to understand what a phantom loan is and why it's not due and payable during your lifetime. And then you'll want to watch the other episodes in this 5-episode series. There's 3 ways to access money out of an insurance policy. And I'm talking about a max-funded insurance policy. My favorite is indexed universal life. That's where I've averaged 9.62% rates of return tax-free ever since 1997. Okay? Now, you can do this too. There's some years, we've earned 25%, 61.33%, even 153% like the year 2021. Let's just be conservative here, 9.6%. That will double your money every 7.5 years. So there's 3 ways to access money as it grows. If you started out like a lot of our clients did, putting in $500 a month, and after 30 years, they've got $1 million. Or they started out with a lump sum of $500,000, and it doubled to $1 million. In 7.5 years, $1 million doubles to $2 million. In another 7.5 years, $2 million doubles to $4 million. In another 7.5 years, and it doubles again to $8 million, and we're in the 30th year. So we have people with $8 million that started out with $500,000, and it's generating a 10% payout tax-free. When you access money at retirement, but you don't have to wait till retirement. You don't even have to wait till you're 59 and a half. That's the beauty of these. But let's just say you want to start accessing money. Now, there is the sad way, and I don't recommend this one, but it's one heck of a return. What's the sad way to access money out of an insurance policy? It's by dying. Now again, none of us are getting out of here alive. I mean, out of this life, right? And so I've had many clients who have passed away sooner than they anticipated. These are called untimely deaths. And money inside of an insurance policy, whether you have $5,000 in there, $100,000 in there, if the death benefit is $2 million or $5 million, when you die, it instantly pays out $5 million, $2 million, the death benefit, tax-free. Nothing else that I'm aware of does that. So the money blossoms. It goes from maybe $100,000 of cash value and pays out $1 million or $10 million or whatever in an insurance policy. That's the sad way. Now, most people don't come to me primarily thinking about, I need to protect myself in case I die, even though they like that benefit. They want to use it for living tax-free income. If you use it as a living benefit, you want to make sure it is not the dumb way. So we have the sad way, the dumb way, and then you have the smart way. The dumb way is by withdrawing the money when you go to retire. And people go, well, isn't that smart? No. Hear me out. Let's say you have $1 million accumulated in an indexed universal life policy, and you're able to get a 10% payout like many of our clients do. That would be $100,000 a year. Now, let's say you started out with $500,000 and you opened it when you were, 55 or 60 years old, and so it took 7.5 years before your 500,000 doubled to $1 million, okay? Now, that 500,000 is your basis. Your basis is the total amount of premiums you paid into the policy. You can access or recover that basis without paying tax. Most investments are taxed LIFO. If you put $500,000 into an annuity, which is a savings account with an insurance company, it grows tax deferred. But when you annuitize it, or you take money out of an annuity, if you take out just the interest that you're earning because you don't want to deplete your principal, it's 100% taxable because it's taxed LIFO. Last in, first out. The last money you're earning is the interest, which is the first money coming out. It's all taxable. Whereas insurance is taxed FIFO, first in, first out. The first money you put in this example, let's say it's $500,000 is your basis. So if you pull out $100,000 a year, it'll take 5 years before you have equaled or recovered your basis. That's tax-free. But if you kept withdrawing money, that would be dumb, because now you're going to start having to pay tax because now you're into a gain. That's dumb. The IRS says, don't do the dumb thing. Take it out the smart way. Change the nomenclature. Call it a loan. Wait a minute. Why would you borrow your money? Now, before I answer that question, if this is intriguing you, share this with somebody who ought to watch this episode. Click like or post a comment. But most importantly, please subscribe to this three-dimensional wealth channel. It's free. Click on subscribe and click the little bell. Then you'll be notified every time I post a new video, which I do almost on a daily basis. This is about you and your brighter future. And stay with me to the end. I want to gift you a copy of my most recent 300-page best-selling book that's flying off the warehouse shelves. And you'll understand this even better. So why would the IRS say, just change the nomenclature and call it a loan, borrow your money? Well, this is reason number 2, and I want you to watch the others in this series of 5. So I'm going to keep it simple right now. Let me give you the milk first. When you borrow money, loan proceeds are not subject to tax. When you borrow money to buy a car or to buy a house or whatever, you don't have to pay tax on borrowed funds. That's been clear in the Internal Revenue Code for over a century. Loan proceeds are not deemed earned passive or portfolio income. The IRS does say this: if it's going to be deemed a loan, it has to pass the scrutiny of a loan, which means the institution loaning you the money has to charge you a minimum statutory interest rate. So let's say that's 2%. Okay, that changes through the years. And so you have $1 million in your insurance policy, and instead of withdrawing the $100,000 a year, now you're going to borrow the equivalent of that interest that you're earning. So far, so good? So now you're borrowing $100,000, and the insurance company is using that money as collateral. You're not withdrawing it. And so now your accumulation balance is going to $1 million, and it's going to be worth $1.1 million if you're earning 10%, and then $1.2 million, and then this phantom loan. And when I say it's phantom, because it's not due and payable during your lifetime. So now you pull out $100,000, next year another 100, that's $200,000. So you have a $200,000 loan balance. You have $1,200,000 of cash because that's growing. $1,200,000 minus $200,000 loan balance equals the same million that you would have had you pulled it out the dumb way and paid tax on that $100,000 the last 2 years. Is this making sense? So the IRS says, you don't have to do that. I mean, if you do it the dumb way, they'll go ahead and tax you, but you don't have to do that. So you'll see at the end of this series, you could retire at age 65, and at age 85, you've been living off of $100,000 a year of tax-free income for 20 years. That's $2 million. That $2 million loan is not due and payable during your lifetime. You can pay it back if you want. I'll show you why you may want to do that sometimes under certain scenarios. But how is that loan paid off? It's paid off with all this cash that is compounding, and that blossoms when you die into a tax-free death benefit. So the loan is paid off, it's washed away, and you don't have any more loan balance when you die for your heirs. It's already subtracted out. But that loan is a phantom loan. It's on the books because the IRS requires it, so it's a true loan. So far, so good? Well, these loans are washed away at death. If this is intriguing you, let me show you how you can learn more about all 5 reasons why you want to borrow money out of an insurance policy instead of withdraw it. So claim your free copy of this book. This has been flying off of our warehouse shelves. I don't want you to miss out. It's called the Laser Fund. Laser's an acronym, stands for Liquid Asset Safely Earning Returns. A max funded indexed universal life. Passes the liquidity, safety, rate of return test, and tax benefits with flying colors. These are the 5 crucial key elements of a prudent investment. This will teach you how to diversify and create the foundation for a tax-free retirement and do it the smart way. You simply go to laserfund.com, click on the link below, and you contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost, but I'll pay for the book. I'll fire out a hard copy to you. There's options there to listen and learn, watch and learn. There's even an 18-hour master class that my 2 sons and I, who are co-authors on this book, we teach. There's also information there on virtual webinars we do on a regular basis, and maybe we even come and do live events in your city. So check it out, but I want you to claim your copy of this book. It's actually 2 books. This one's for the left brain, this one's for the right brain. This has the stories, this has all the charts and graphs. So claim your free copy now. This is the beginning of your brighter future to have tax-free income the smart way.